Well, if you're on the East Coast, guess what? Whatever this snowmageddon's going to be, it's going to be. So I kind of just say, let it snow.
Since we've no place to go, let it snow, let it snow, let it snow. And it doesn't show.
Hey guys, it's your favorite mortgage guy, Steve here. It's Friday. The weather's kind of sunny outside. I just walked across the parking lot and got lunch. And I didn't really need a jacket on, but yet snowmageddon, like you said, let it snow. Snowmageddon's coming. Interesting part is, if you're like me, during the beginning of the week, we were expecting just a massive blizzard. Now, where I live, the temperature high is supposed to be, or the low is supposed to be 34 degrees, and we're getting a wintry mix. I think that translates into it's just going to rain. Some of you have tempered back from 2 foot of snow to a foot to inches, and now just maybe ice. I don't know. But whatever it is, just be safe and be prepared. So, listen, let's start with your questions. What are rates doing? And does it benefit me to pay points on a purchase or a refinance? That question came up 2 weeks ago, but it seems like it's coming up more and more because rates are starting to drop. So, what are rates doing? Right now, they're flat. Last couple of weeks, last week and a half, I would say, market tempered back. A lot of it's because of the noise out there between the Federal Reserve making decisions, different chairmen. I'll talk about that a little bit lower in the section or in the segment. And then a lot of it has to do with what happened at Davos this week, where it was zigzag, Greenland, oil, green, uh, things for windmills and all this crap, and it just affected the market. Right now, things are stable. Things seem to be improving. How do I start the process? You give me a call. Simple as just as simple as that. Why should I give up my low interest rate? Guys, again, I'll repeat myself. I know I've been saying this for the last several months. Only you care what your interest rate is. And you can go and brag to your neighbors that you got a 2 point whatever. But if you're like my average client who's calling me right now and going, hey, Steve, I got $40,000 or 30,000 or even 20,000 in credit card debt at 30% interest. I went out and bought a car. My payment's $1,100. I got some other debt. It really would benefit me if I took a little higher rate and cashed out and paid off all my non-tax deductible debt and made it tax deductible and saved $1,800 to $2,000 a month. Because that's what my average client's doing right now, is saving $2,000 a month. And they don't care that they're giving up their 2%, their 3%, their 4%, or even their 5% rate. But even the ones that are at 8.5, that bought houses back in 22 and 23, they're still saving money. So, guys, just listen, stop the madness and stop picking on everybody around you. Just refinancing and make your life easier, because improving your cash flow is making your life easier. Should I look at an arm for refinancing or financing? That's a great question right there. And what I would say is this. So keep this in mind. There is such a dichotomy between arm rates and fixed rates. The reason is this: they call it runoff. So runoff means that you get an arm, right? And rates start dropping. What are you going to do? You're going to pick up the phone. You're going to call me and go, hey, Steve, you know that arm that we got or refinance into? I need you to refinance me out of it. That's what's called runoff. Well, the investors are looking for the return on their investment. So what are they going to do? They're either charging discount points for those rates, or they're making the rates not attractive, which is kind of what's happening right now. Now, the jumbo investors of over $1 million, yeah, you might be able to get something a little better, but they're few and far in between because not all of you have $1 million loans. So, should you go for an arm versus fixed rate? I would not do that. Now, something else that came up this week, it actually came up twice this week. Should I make extra should I make extra payments on my loan? All right, guys, listen, here's what I'm going to tell you. Let's just pick a rate of 6%. If you've got a rate of 6%, but yet investments are paying 8+%, I would pre-tax take all the most I can out of my payroll deductions pre-tax and put it in my 401k, because you're getting 8% or more. And that's pre-tax dollars. So that's like free money. And your mortgage is tax deductible. So does it benefit you to pay off your mortgage early? Not necessarily, unless you want to brag, or unless you're getting ready to retire or something like that. But if it's me, I'm going to kick the can down the road, because I can figure it out in retirement. And then more than likely, because you've invested all that extra money, you might have a couple $100,000 more to put against the principal down the line. Okay, before I start, I want to remind you of something. First, let me take a sip here. Scott, while I'm taking a sip, tell them how many pennies are in a dollar.
Hey, good morning, Steve. I was thinking, unless my second grade math has changed, I'm pretty sure there's still only 100 pennies in a dollar. Let me know if that's not so.
Okay, like Scott said, there's only 100 pennies in a dollar. The reason I bring it up is because I received at least 25 phone calls this week that this so-called predatory lenders or that predatory lender, these are the ones I talk about. These are the people that are just cold calling you. And let's talk about that word predatory for just a second. These are lenders that aren't doing anything magical. They're simply trying to keep their doors open by advertising teaser rates, rates that look great on paper, but here's the catch. They're not going to give you the true cost estimate unless you first let them pull your credit. Why would you do that? All right, that should be the red flag right there. A legitimate lender can explain their pricing and fee structure without forcing you into a credit pull. So don't fall for unreasonable tactics designed to create urgency or confusion. Remember, there's still only 100 pennies in a dollar. Now, math, that doesn't change because marketing sounds flashy. Before you let anyone pull your credit, before you chase that teaser rate, call me and let's get the facts. I'll walk you through the real numbers, real options, and a real plan. No pressure, no games, just real information. Because the right move isn't waiting, the right move is being informed. So call me, let's talk. Now, let's pivot to the housing market. Take a look at this chart. I'm not sure where Katie's going to put this, but the National Association of Realtors, or NAR, just released their existing December home sales. And yes, it showed a 9.4% drop in sales. But let's be real for the moment. This is December. People aren't focused on selling houses. They're focused on holidays, family, travel, and not buying homes. So context matters, as a seasonal slowdown is not a market collapse. Now, I've also had a lot of questions lately about how interest rates are actually calculated. Now, one of the things that you need to know is this. As you're looking at this chart and you're trying to calculate where interest rates are, I want you to look at these numbers and I want you to focus on a couple of specific things. Look at what percentage. 16% of people overbid on their house because they wanted it. 19% waived the appraisal, and the chart's not in front of me, but I think it's 13% waived the home inspection. The reason I tell you that is, remember all the times I've been telling you, buy the house, not the rate, because houses are selling off the shelf. Prices are going up. Now, the other reason I tell you that is the context that I was talking about. If you remember, when I told you, houses sell, supply and demand. That context is important because that equity factor always wins. So guys, get out there and buy the house. If you're serious, buy the house. Now, if you remember last year, a lot of times I get questions about how rates are calculated. So here's the thing. LLPAs, they're called loan level price adjusters. Now, what they mean is this. These fees are implemented by Fannie Mae, Freddie Mac, Ginnie Mae, and they're based on very specific factors. Like, for example, your credit score, the product you're picking, whether it's a 30-year fixed, a 15-year fixed, an adjustable rate mortgage, or the down payment you're putting down, or the property type, like, for example, a condo, or an HOA, or a townhouse, a single family home, a log cabin, whatever it is. Occupancy, whether you're going to live there, whether you're going to invest in an investment property, a second home. Every lender has to price these loan level price adjustments in their system. They're standardized across the industry, not made up, not negotiable, not unique to one lender. So why, when you see wildly different rates advertised online, now you understand this. The underlying costs are the same. What changes is how transparent or opaque someone chooses to be, and they won't tell you until they truly price out the loan. Let's talk about Fed policy right now because that's what matters the most. We're very close to naming a new Federal Reserve chair. Now, the two leading contenders right now are Rick Ryder, Kevin Warsh. And from everything we're seeing, it's an even split. Why is this so important? Because ahead of next week's Fed meeting, the market may start pricing in the reality that federal current Fed Chair Powell is becoming a lame duck. If that happens, any negative comments he makes could be neutralized by the expectation of new leadership. And that's often how markets turn before an official announcement is made. Now, as long as the economic data cooperates, this sets us up for some real opportunity for real interest rates to drop throughout 2026. How much? Anybody's guess. Nobody knows. Now, let me bring home some real data, as I mentioned earlier, from the NAR. I'm bringing this back around because I want to repeat myself. 16% of homes sold above the list price. 19% waived their appraisal. What that really meant was they agreed to cover the difference if the house didn't appraise for what they paid for it. 18% waived the home inspection. Now let that sink in for a second. That's why I buy the house, not the rate. Those are not signs of a weak housing market, right? They're just not. Those are signs of a strong competitive market. Now, this is exactly why it's important for you to tell your friends, your family, everybody that rates move. Of course they do. Refinances happen because rates are going to drop and you're going to buy this house. You might have equity. Equity builds, but you can't refinance a house you never bought. So get out there and buy the house and we'll figure the rest out. Guys, that's what I do. Got all the software. Now, if you're hearing the noise, you're seeing flashy ads or wondering whether you're being told what actually makes sense, stop guessing, just pick up the phone, send me a text, let's have the conversation. So here's the bottom line. I'm your favorite mortgage guy. We've talked about 100 pennies in a dollar. We've talked about getting out there and buying the house. What are you waiting for? So do me a favor. All my contact information's here, wherever Katie's putting it. Go to my socials, friend me on Facebook, Instagram, Snapchat, TikTok, LinkedIn, YouTube, all these different places. I'm there for you guys. But more importantly, I really could use your referrals, so please tell your friends. Hope you guys have a phenomenal, hopefully not a snowy weekend. I'll talk to you next week.
The
Bye.
lights are turned way down low. Let it snow, let it snow, let it